For more on today's market action, I want to bring in Eddie Ghabour, who is the author of The Common Sense Bull, and he is, of course, the co-owner of Key Advisors Group. Thanks so much for joining us today, Eddie.
Thank you for having me.
So as we just recalled, now it seems to be volatility is the name of the game. It pretty much is the new normal from here on out. How are you looking at today's market action, especially after some of those declines that we saw on Thursday?
So I think the action that we're seeing today is very similar to what we saw on Friday, which is what we're going to continue to see, in our opinion, over the next few weeks because of the amount of uncertainty that's out there. So we had the quick snapback that far exceeded our expectations on the upside. And now we're in this range now that I think we're going to stay in because of the outbreaks of the virus, some of the China concerns that are rearing its ugly head again. And then the other thing I think the market's going to start to focus on is the debate on what the next stimulus package is going to be for July. I think there's going to be some back and forth and not the bipartisan agreement that was on the first set. And that's going to cause a rocky road from the investment side of things. So we are buying the dips that we saw like on Thursday, but we're being very cautious in when we're buying. We're not jumping in with both feet because we still think there could be some downside here in the near term,
Yeah, of course, Eddie. As you were speaking, the Dow now in positive territory as the news that the Fed updates its corporate bond ETF facility to now buy actually individual corporate bonds in the secondary market to create a portfolio that's based on a broad, diversified market index of U.S. corporate bonds. What's your reaction to this news? Do you think this will have a long-lasting impact as we look at market activity this week?
So I think the one thing the market has really going for it over the next couple of years, as I pushed out in our notes, is the Fed is going to be more accommodative than they ever have been. Now, we can create asset bubbles long-term from this, as well as the amount of debt that's a concern for us. But in the interim, the Fed is giving green light for risk assets, whether we like it or not in regards to the disconnect with Wall Street and Main Street. The bottom line is it's a green light in regards to risk assets, which is why we've said to buy the dips, because the Fed has pretty much said they're going to do everything and anything they can within their powers to support the markets.
You know, Eddie, one group that is certainly buying the dips is the retail investor. And that has been a fascinating sector to look at over the last couple of weeks. SocGen coming out with a note this morning saying that they actually do play a significant role in the market activity. Of course, this is in sharp contrast to Barclays last week, saying that they're dismissing the connection entirely. What's your stance here? Do you feel as kind of these day traders are really pushing the market higher?
You know, I think they absolutely are having an impact. What I worry about on those day traders are the types of stocks they're speculating on. Some of these companies, like look at Hertz, for example, they announced bankruptcy, and then you get a lot of retail investors jumping into stocks like that. Normally, investors that are investing in companies like that, it doesn't end well. We would rather invest in companies with good, strong balance sheets. They don't move as much as those high speculative plays. So my concern for the retail space is them going in as an uninformed investor for some of them and buying these really speculative companies, because normally that does not end well.
Yeah, I mean, that's to your point, though, they are buying the dip, right? And there is more increased risk appetite to a certain extent. So hopefully this could democratize sort of access to market activity during this period of time.
Yes, without question. I mean, when you look at what the retail investor returns are versus some of the major money managers out there, they've probably outperformed them in the short term because they've looked at this market as an opportunity where many professionals like ourselves have been a little bit more cautious as we're in this uncharted territory from an economic backstop.
Thank you so much, Eddie Ghabour, for joining us. You're the co-owner of Key Advisors Group. Stay safe.
Thank you. You too.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.